Imagine selling your house for $50,000, only to watch it become worth $4 million a few years later. That sick feeling in your stomach? That's exactly what Canada is living with right now. Except we're not talking about a house. We're talking about gold. Billions of dollars worth of gold. And the decision to sell it might go down as one of the most catastrophic financial blunders in modern history. Canada once held significant gold reserves, a safety net built over generations, a buffer against economic chaos, a symbol of stability. Then someone in a suit decided it was time to let it go. Between the 1980s and 2016, Canada systematically liquidated nearly all of its gold holdings. The average price they got, about $120 per ounce. When the dust settled, Canada had walked away with roughly $4.3 billion. At the time, policymakers probably patted themselves on the back. They'd turned a static asset into liquid cash. Smart move, right? Wrong. Dead wrong. Because today, if Canada had simply held onto that gold, those same reserves would be worth approximately $162 billion. Let that number sink in for a second. $162 billion. That's not a typo. That's not an exaggeration. That's the cold, hard reality of what was left on the table. We're talking about a loss of over $150 billion in potential value. That's more than the GDP of some entire countries. That's generational wealth, evaporated. So how did this happen? How does a G7 nation, one of the wealthiest countries on the planet, make a decision this monumentally disastrous? To understand that, you need to understand the thinking at the time. Throughout the late 20th century, gold had fallen out of favor among central banks and finance ministers. The era of the gold standard was over. Currencies were floating. The dollar reigned supreme. Gold was seen as a relic, a barbarous relic as some economists called it, something your grandfather hoarded but modern economies didn't need. Canada wasn't alone in this thinking. Other nations dabbled in gold sales too, but Canada took it to an extreme. By 2016, Canada's gold reserves had shrunk to almost nothing. We're talking about a few hundred ounces, barely enough to fill a couple of safety deposit boxes. For a nation of Canada's size and wealth, this was unprecedented. The official reasoning? Gold doesn't generate yield. It just sits there. Meanwhile, that money could be invested in bonds, currencies, or other income-generating assets. It sounded logical. It sounded sophisticated. But it ignored one fundamental truth about gold. Gold isn't just an asset, it's insurance. It's a hedge against the chaos that markets, governments, and economies inevitably face. When currencies collapse, when inflation spirals, when geopolitical tensions explode, gold doesn't care. It holds its value. It's been doing that for thousands of years. And while Canada was busy selling, the world was about to enter an era that would prove exactly why gold matters. Fast forward to today, gold prices have absolutely exploded. In 2024 and into 2026, gold has been smashing record after record. We've seen prices surge past $2,000 an ounce, driven by a perfect storm of factors. Central banks around the world, the very institutions that once dismissed gold, are now buying it in record amounts. Why? Because trust in fiat currencies is eroding. Because inflation has proven far more persistent than anyone predicted. Because geopolitical instability, from wars in Europe and the Middle East to tensions between superpowers, has investors fleeing to safety. And where do they flee? To gold. Always gold. China has been stockpiling gold for years, quietly building reserves that now rival the largest in the world. Russia, despite sanctions and economic warfare, has been doing the same. Central banks in Asia, the Middle East, and even parts of Europe have been net buyers, not sellers. They understand something that Canada apparently forgot. In times of crisis, gold is the ultimate fallback. It's the asset that survives when everything else burns. But Canada? Canada is sitting on the sidelines with empty vaults, watching the price climb higher and higher, knowing that every dollar of increase is a dollar that could have been theirs. $120 an ounce seemed reasonable at the time. Maybe even smart. But today, with gold hovering around the $2,000 mark and climbing, that decision looks absolutely catastrophic. Let's put this into perspective with a real-world comparison. Imagine you're managing a family's savings, and you decide to sell all the insurance policies, all the emergency funds, because you think the stock market looks good. Then a crisis hits. The market crashes, medical emergencies pile up, and you have nothing to fall back on. That's essentially what Canada did on a national scale. The government liquidated the insurance policy right before the world entered one of the most volatile and uncertain periods in modern history. The $4.3 billion Canada received might have seemed substantial. But what was it used for? It went into general revenues, likely absorbed into the budget, spent on programs, infrastructure, or debt reduction, all fine uses of money, but nothing that comes close to the strategic value of what was given up. Because that gold wasn't just worth $4 billion. It was worth the optionality, the flexibility, the security of having a hard asset when everything else is uncertain. Now let's talk about the missed opportunity cost, $162 billion. What could Canada do with that today? You could fund healthcare for years, you could rebuild crumbling infrastructure, you could create sovereign wealth funds that generate income for generations. You could stabilize the currency during times of stress. You could have leverage in international negotiations because nations that hold gold hold power. But instead, that potential sits in someone else's vault, or more likely, melted down and sitting in jewelry stores and private collections around the world. And here's the kicker. Gold's run isn't over. Many analysts believe we're still in the early stages of a multi-decade bull market for gold. As debt levels explode globally, as trust in central banks wanes, as the dollar's dominance faces challenges from digital currencies and rival economic blocs, gold's role as the ultimate store of value only strengthens. If gold hits $3,000 an ounce, which some experts think is inevitable, Canada's missed opportunity grows even larger. We'd be talking about $250 billion in lost value. It's almost too painful to calculate. There's also a psychological element here that can't be ignored. When a nation holds gold, it sends a message. It says we are stable, we are prepared, we have depth. When a nation sells all its gold, especially at rock-bottom prices, it sends a different message. It says we don't believe in hedging risk. We're all in on the current system. And if that system fails, we have no plan B. Other countries notice this. Investors notice this. And in times of crisis, confidence matters just as much as the actual assets. Canada's decision has been dissected by economists, financial analysts, and armchair critics alike. Some defend it, arguing that hindsight is 20/20, that the decision made sense given the data available at the time. Others call it exactly what it is, an unforced error of staggering proportions. The truth is probably somewhere in between, but the results speak for themselves. A strategic asset was sold for a fraction of its future value, and the nation is now paying the price in lost potential. What makes this even more frustrating is that the warning signs were there. Even in the early 2000s, some voices were cautioning against wholesale gold liquidation. Gold had been in a bear market for 2 decades, but that's exactly when smart money accumulates. Buy low, sell high. It's the oldest rule in investing. But Canada did the opposite. They sold at the bottom and watched the market soar without them. This isn't just about money, it's about sovereignty. It's about resilience. It's about having the tools to navigate an unpredictable world. Nations that hold gold have options. They can weather currency crises. They can back their monetary policy with something tangible. They can negotiate from a position of strength. Nations without gold are at the mercy of market sentiment and the goodwill of others. Canada chose the latter path, and the consequences are becoming clearer every day. The lesson here extends beyond Canada. It's a cautionary tale for any government, any institution, any individual that dismisses the value of hard assets in favor of short-term convenience. Markets are cyclical. What looks outdated today might be essential tomorrow. What seems like dead weight might be the only thing that saves you when the storm hits. And gold, despite all the modern financial innovations, despite all the fancy derivatives and digital tokens, remains the one asset that has stood the test of time. So where does Canada go from here? Can the mistake be undone? Technically, yes. Canada could start rebuilding its gold reserves. But here's the problem. Gold is expensive now. Buying back what was sold would cost tens of billions, and every dollar spent is a reminder of what was squandered. It's like trying to buy back that house you sold for $50,000 after it's worth $4 million. You can do it, but it stings. And politically, it's a hard sell. How do you explain to taxpayers that you need to spend billions reacquiring something you sold for pennies? The reality is that Canada is unlikely to rebuild significant gold reserves anytime soon. The political will isn't there. The focus is elsewhere. And so the country will continue to operate without the safety net that gold provides, hoping that the current system holds, that crises remain manageable, that the gamble pays off. Maybe it will. But history suggests that nations without hard assets eventually regret it. This story should make you think about your own financial decisions. Are you holding assets that seem boring or outdated but provide real security? Are you chasing yields and returns without considering what happens when things go wrong? Are you dismissing time-tested strategies because they don't fit the current narrative? Canada's gold sale is a national-scale version of mistakes individuals make every day. The scale is different, but the principle is the same. Sometimes the smartest move is to hold on to what protects you, even when everyone else is telling you to let it go. $120 an ounce. $4.3 billion. At the time, maybe it seemed reasonable. Maybe it even seemed smart. But today, with the benefit of hindsight and the cold math of current gold prices, it stands as one of the most expensive mistakes in Canadian history. $162 billion. That's not just money. That's opportunity. That's security. That's power. And it's gone. Sold off, liquidated, turned into cash that evaporated into the budget, while the gold itself went on to become one of the best performing assets of the 21st century. The next time you hear someone dismiss gold as a relic or suggest that hard assets don't matter in the modern world, remember Canada. Remember what happens when you sell your insurance right before you need it most. Remember that markets have long memories, and decisions made in moments of overconfidence can haunt you for generations. Because somewhere in a vault, the gold that Canada once owned is still sitting there, growing more valuable by the day, just not for Canada.